Talk Media Limited, where complex ideas are explained clearly. Hi, I'm TaxMax. Let's break down today's tax topic.
Quick tax fact before we start. A company can be used to hold family wealth for generations, but the tax rules change completely depending on who controls it. A family investment company, often shortened to an FIC, is not a special legal structure. It is simply a private limited company used by a family to hold and manage investments. The company owns the assets. Family members own shares in the company. What makes an FIC distinctive is not its legal form, but how ownership, control, and economic benefit are deliberately separated. In most FICs, parents or founders retain control through voting shares. Children or other family members hold shares that carry economic value, but limited or no voting rights. This allows wealth to grow inside the company, while control remains with the older generation. From a tax perspective, HMRC focuses heavily on who controls the company, not just who owns value. Companies offer a level of flexibility that trusts often do not. Companies can retain profits at corporation tax rates, reinvest income without immediate personal tax, and allow control to be retained while value shifts over time. Unlike trusts, companies are taxed as separate legal persons, which changes how income, gains, and inheritance tax are assessed. Investment income earned by an FIC is subject to corporation tax, not income tax. Dividends, rental income, and capital gains all arise within the company. The applicable tax rates depend on the nature of the income, whether reliefs apply, and whether the company is classed as a close investment holding company. Many FICs fall within the definition of a close company. If an FIC is also an investment holding company, it may be treated as a close investment holding company. This matters because such companies cannot access the small profits rate, are excluded from certain reliefs, and may face higher effective tax rates. FICs are often used as part of inheritance tax planning. Parents may retain control while growth shares are issued to younger family members. Over time, value accumulates outside the parents' estates. However, inheritance tax rules focus on control, benefit retained, and whether gifts are genuinely effective. HMRC may apply settlement rules where income is diverted, but control or benefit is retained. If parents retain excessive control or benefit from company income, HMRC may seek to tax that income on them personally. Eventually, funds must be extracted from the company. This may be done through dividends, salaries, loan repayments, or winding up. Each route carries different tax consequences. FICs require careful governance. Share rights and documentation must support the intended tax outcome. Poor implementation attracts challenge. And this brings us back to the fact we opened with. Family investment companies live or die on control. The tax outcome is driven not by the label FIC, but by who really controls the company and who benefits from its income and growth. A family investment company is where the spreadsheet looks brilliant, right up until HMRC asks, who's really in charge? Educational content only. This is not tax advice. Tax rules can change.
Educational content only, not advice. Rules can change. Thanks for watching. Clear explanations, one place, Talk Media.